The views, thoughts, and opinions expressed are the speaker's own and does not represent legal or accounting advice or counsel and should not be seen as such. The material and information presented here is for general information purposes only, a conversation. We make no promises or assertions on how this information will impact your business, your personal life, or financial well-being. The information relayed does not imply endorsement or offer opposition to any specific organization, product, or services. Welcome to Shift. I'm your host, Lori Power, and I'm looking forward to our conversation. I want to thank you very much for joining me today, Dave, and talking about all things group retirement savings. Can you take a minute and introduce yourself, introduce People Corp, and your role there?
Sure. So, as you can see, my name is Dave Campbell. I am a group retirement consultant here at People Corporation. For anyone who's not heard of People Corporation, we hope that everyone's heard of us, but we know that there's some people that haven't. We are Canada's largest independent HR benefits consulting firm. So obviously, we do a lot of health, wealth, dental. We've got HR services, this sort of thing, and obviously we've got a group retirement team as well, which I am a part. So my role is I work with a ton of small businesses and advisors in helping their clients set up group retirement savings programs. I often say that I am the foremost expert on small businesses, small business group retirement plans. I don't know if that's true, but I'm waiting for someone to tell me I'm not, and until they do, I'll keep blowing my own horn there. So,
Well, toot toot to you. When we talk about retirement plans, we talk about retirement savings, putting something in place for the employees. That dovetails very well into the SEPA program and building out succession and exit planning, because it's not just the business owners that are looking toward their retirement and their
Mhm.
next best adventure, but it's also their employees. What, in your opinion, is a retirement plan when it comes to organizations putting in a group RSP?
So, very good question. I think if we look at sort of the landscape of group retirement plans, regardless of the company size, you're usually looking at the employer putting in around 2 to 6% is sort of the amount of money that we would typically see going into these programs. There are some employers out there who make requests for programs where the employer is not contributing. We tend to stay away from those. While the employers might see it as a benefit to be able to offer the lower fees that one would get from a group program as compared to an individual program, our experience is the employees don't tend to value the programs very much if the employer is not putting money into it. So first and foremost, any employer who's putting in a retirement program, obviously for the recruiting and retention aspect, as well as you want to make sure that your employees are taken care of in their later years. So they're typically looking at, again, group RSP is the easiest one. There's a lot of other plans out there that can be paired with RSPs or replace RSPs. But the RSP is the easiest one. So employers have to think about, obviously first and foremost, do they have the money for it, right? If things are really tight as far as operating costs and that and so forth, there might not be that kind of money in for it. But again, 2 to 6% in there somewhere. So when we say 2 to 6%, someone's thinking about, well, how much is that exactly? We're talking about essentially the payroll, right? So yeah, so that's really the first and foremost, thinking about what do you have the money for it, right? Thinking about what that's going to cost. And as well as what are you trying to achieve with it is the other thing, right? So if you're in the type of industry where there's high turnover, you might want to incentivize people staying on a little longer. So in terms of years of service, you can start to increase the match amounts. You can also, if you've got sort of high turnover in the early stages, like if people stick around for a year, they're there for 5, but sometimes they don't make a year. You can also put in waiting periods and this sort of thing. So there's tons. Big thing is There's lots of flexibility with these. You're not really painted into a corner with these rules and that sort of thing. There's lots of different ways that they can put these together.
I'll agree with you when we talk about benefit programs, and I too do not put plans in place where the employer is not contributing,
Hmm.
because I think added to that, how much do you want to contribute? I think too, you have to really assess, is it a benefit? Am I creating a benefit here? And what does constitute a benefit to my employees? And certainly lower fees. I'm sure that there are lots of association programs out there that employees could belong to on their own and still benefit from lower fees. But
Hmm.
the actual benefit is that matching of the payroll. It is that is what retains staff over the long term. So I will
Yeah.
agree with everything you said, but most especially, I wanted to put an exclamation mark on that. What constitutes a benefit plan?
Right.
And speaking of plans, when we put in a group RSP, the one thing that I'll say is that a group RSP is not a financial plan. It is
No.
just one cog in that machine that is going to get you to your next best adventure, so to speak. So it is just that one piece of the puzzle, but it doesn't constitute a plan, even though plan is in there. Uh, When you're evaluating the different programs available on group RSPs, perhaps even the TFSAs or the deferred profit sharing, something that I'm going to lump all of those together just for the sake of
Hmm.
our conversation and say you're offering something to your employees that is a financial vehicle for their retirement. Am I safe in saying that?
I think so. The only caveat I would put on that is with the TFSA. Now, personally, I think it should be used for retirement. However, it is a savings vehicle that can be used for short and midterm savings goals. People will use them to buy cars, pay for vacations, this sort of thing. We do want to see people locking it away as long as they can and getting the most advantage they can out of it. One thing we also see with, particularly in organizations with younger people, like we're thinking sort of early 20s, um, there are some employers out there who offer their match not only through the group RSP, but the employee also has the option of putting it through the TFSA. So the reason they do that is because some of the feedback they get from their younger employees is, yeah, the RRSP is great and all, but we're talking about 40, 45 years down the road that I should be ideally using this. Whereas I'm looking at the next 10 years of my life as buying cars, having money to put on a house, this sort of thing, the vacations that they'll inevitably take. So that's also coming up as well is, if it, again, organizations that have a lot of younger people in it, we also know that there tends to be higher turnover with younger employees. So they'll put the TFSA on those ones as well and give that option of letting the employee pick where that employer match goes. So.
I'm glad you brought up the timeline because that is something that I do talk to employees about when we
Mhm.
are looking at placing in a program for them. Gone are the days where we can say, okay, well, over the next 25 years, this is what it will mean for you, because employees don't think in terms of 25 years anymore and probably haven't done in the last 25 years. Um,
Mhm.
where they are today may not be where they are in 10 years' time, depending on whether they're reaching a ceiling, whether they're re-careering or
Mhm.
moving on for a number of other reasons. So I really like that. When I like the point that you made too about the TFSA portion for the employees consideration. And I'm very much in favor of the deferred profit sharing aspects for the employer's contribution. Now I can say, but I'm not, I'm interviewing you today. So what do you like about having the employer's portion be the deferred profit sharing?
So the advantage of there with the deferred profit sharing is really twofold. The first is it's the only arrangement that you can have a vesting period on. So of the ones we're talking about today. So what that means is the employer for up to 2 years can have a vesting component on it. So what that means is if you said, we'll take the 2 years, the full 2 years as an example. If a new employee has only been part of that program for, we'll say, 18 months, they leave their current employer, move to a new one. the sponsoring employer, the original employer for that DPSP, has those contributions returned back to them. So now I'm out here in Calgary. We've got a lot of oil companies. We've got a lot of people working on the oil rigs. There's very high turnover on those rigs. They tend to jump ship pretty quick. So that deferred profit sharing plan is really attractive to those plan sponsors because they're seeing they're seeing, let's say, 20% of their workforce is only there for 18 months. And they put all of it, if it's in an RRSP, they put all this money in the RRSP. As soon as the employee leaves, they walk out the door with that money. Whereas with the DPSP, they're not walking out with that money. It gets put back into the program for the employees and the employer obviously can choose how to allocate those funds to remaining employees or new employees from there. So that's the first advantage of the DPSP. Second advantage of the DPSP is payroll taxes. So employer contributions to an RRSP, you do need to pay your payroll taxes, EICP. With the DPSP, you do not have to pay those. So particularly in larger organizations, that can be quite a bit of savings there as well. I did want to mention one other advantage that we don't often see when we set up the DPSPs, but it is there. For those years that are not profitable for the employer, they can then decide that they are not going to make contributions to the DPSP. So if an employer gets through a little bit of a rough patch, they do have that safety net where they can, they're not violating their own plan rules by not making contributions to the DPSP. Whereas if you just have the straight RRSP and you decide you're going to stop contributions, that's going to probably cause a little bit more trouble. So
And it's not like we haven't seen that, Dave. I mean, you take the
yeah.
pandemic. The pandemic is an excellent example where
Mm-hmm.
many businesses may have had that year to 18 months where they weren't profitable as they were readjusting or making changes to accommodate the new normal, if you
Mm-hmm.
would.
Yes, exactly.
I like that vesting period. I like the idea that it helps with that retention of staff. Sometimes benefits are the one true thing that will dictate whether an employee stays or goes because it dovetails right into the company culture and that compensation on what's holding them there. When we're talking about membership and participation, unlike a traditional employee benefit program, when you put in a group RSP, participation levels are not mandatory, are they? They're voluntary. The employee can choose whether they're walking away from the employer's money is the easiest way to say it.
Yes. So you can make them mandatory. Typically, they're not because you don't want to be forcing people to make contributions if if their budget's really tight. So most programs are voluntary. But again, as you mentioned, that whole aspect of leaving money on the table, if someone's not participating, we see that as an education opportunity, an opportunity to engage the individual. At the very least, it's great that they're putting money into the program. If they really don't want to, then that's fine. But at least, I mean, on the employer's behalf, as well as the advisor or the carrier supporting that employer, communicating to that employee that they are leaving that money on the table. It definitely gives everybody a little bit more comfort that yes, this has been communicated to the individual. They are turning the money down, and they're going to go on their own with this. So.
Even if the employer decided to do a 6% match, say, I
Mhm.
find most common is in around that 4 to 5%
Yeah.
match. So I'm going to keep it there. I'll say, say the employer decides to do that 4% match
Mhm.
and the employee wants to participate, but they only want to participate, say 1%. The employer then is only on the hook to match that 1%. They will go upwards to that 4% if the employee wants to match it, but it is a matched program by and
Right.
large. So even if the employee only wanted to contribute 1% of their payroll or
Mhm.
their pay, I should say,
Yeah.
then the employer is only going to match to that amount. So it's an equal opportunity.
Right. Yeah. So that is the structure of most of the programs. It's not, I mean, obviously there are employers out there who will just say, yeah, I'm going to put 3% in, regardless of what the employee puts in. Those definitely exist. But again, most common is it's a 1-for-1 match, anywhere from 0 to, if we take the example of a maximum 4% match, anywhere from 0 to 4% is what the employee picks how much the employer is putting in, right? So employee puts in 1, employer puts in 1. So that's really how that, so it gets buy-in from everybody. And then the other thing too is when we talk to plan members or prospective plan members about their employer savings programs, We can tell they, obviously when people are not participating, it's because their budgets are too tight, this sort of thing. So we give the advice of, well, you can always start it at 1% or 0.5%, and you will notice over time that you're not going to notice the money coming out. It's that automatic withdrawal, right? And then so over time, we advise, yeah, start it at 1%. Take a look in 3 months. If you feel like you're comfortable with it, then you can dial it up to 2%. 3 months, dial up to 3%, et cetera. And then before they know it, they're contributing the full amount, and the impact has been mitigated over that time on their budget, right?
One of the best books I ever read as a new adult, I'll say, is The Wealthy Barber.
Yes.
And talking about the pay yourself first, getting
Mhm.
used to it. And to your point, that's what brought it to mind is get used to paying yourself first, which is what a group RSP is essentially, is you're paying yourself your future self. You're putting
Right.
money away today for your future self. The employer can then segment as well, length of service. They can classify who they're going to put the plan out to. So there is a lot of flexibility in building this as
Mhm.
part of their overall culture and compensation program.
Yeah, and it's not just, I mean, we'll come back to this idea of how much flexibility are in these programs. So you can do, the first year you're in is a waiting period, for example, and then you start them at 2% for years 2 to 4, and then it goes up to 3% for 4 to 6, and then above 6 years. So yeah, having that graduated system where again, that retention incentive. So the longer people are in, the more money they get. And of course, there's flexibility in that as well. You can do it by job titles as well. So quite often we'll see management having a higher percentage than office admin having higher percentage than floor workers or what have you, or foremans, or all these sorts of different segmentation that you can put within your plan. There's almost limitless number of combinations that you can come up with. So.
And volume of participation matters when we're talking about the growth and the compounding of the fund itself. Can
Mhm.
you walk me through the basics of that?
Sure. So how any sort of new program, which we refer to as a startup program, uh, all of the carriers that we work with, they're going to give you they're going to give a set price for basically their smallest plan size, right? So, which is great because there's not a lot of we know what all of the options are, we know what the best deal is, we know this kind of thing, right? And so obviously over time, employers are putting money into the program, employers putting money into the program, the investment growth is there as well. And then over time, obviously, once the plan gets bigger, carriers will start to look at those plans in terms of the asset sizes. Higher asset sizes are going to get you lower pricing. Now, when we talk about pricing, what we're talking about is the fees on those investments. So for the employer, there's no additional charges for these programs. It's really just the entire program is paid for those people investing their money in certain investments, and that's the cost. So when you're looking at a small startup case, depending on the carrier, it could be 1.3 to 1.8% in there. We typically, at People Corporation, will look at a plan once it crosses the $1 million in assets threshold. So, if you've got 5 people, it's going to take a little while, but if you've got 20 or 30, it's not going to take that long to get to the 1 million. And so once it hits the 1 million, we would then obviously with their current carrier say, hey, you guys should be repricing this. Let's give them cheaper prices on their investments. And then also look at marketing the plan as well. So then we'd say, hey, this is the plan that this plan sponsor has. These are the assets. This is how many people. This is how much money goes in there every year. Would you like to quote on this plan? So we can go out and we can shop and talk to all the carriers. And if the employer is happy with their current carrier and they get a discount on their fees, they'll often just go with that. But quite often we'll take a plan out there, and as a result of the marketing, they'll find that another carrier is more aggressive in trying to get that carry that plan for them, and that will be reflected in the pricing. It's a great news story for the employees because you can say, hey, you guys have been putting this money in here. We've had this program for 5 years or 10 years now. And now you're going to see this reduction in your fees. Over time, this reduction in your fees could be 10 to hundreds of thousands of dollars for people, right? So that's a really good news story there as well. Not just sort of putting the plan in place, but you have the opportunity to reprice and continue telling those good news stories down the road.
And you want that mushroom cloud, right? You want that
Mm,
mushroom cloud of growth. And that's the hardest thing is the first couple of years into a group RSP or any investment, if you put it that way,
hmm.
is you're putting money in, you're putting money in, you're putting money in, and the growth is so small that you're not seeing the big compounding results that may happen. And then, but when you're participating in a group RSP, you're participating in the volume of everybody else putting their money in, and it's easier to achieve that mushroom cloud in a faster means because you are participating with everybody in your organization.
Yeah, and a good sort of ancillary point to that as well is if you were to go and even if you were to go to a bank or credit union and set up your own individual RSP, the pricing you're getting on investments is based on your individual sum of money. Whereas with a group RSP, the carriers, they're pricing it on the entire sum of money. So that's why you see much lower fees in group programs. You've got that bulk purchasing power. And again, that's typically through the insurance carriers. There are a lot of banks will offer what they call a group RRSP, particularly to employers that are already doing banking business with them. But what we see is the pricing is through those banking programs is more reflective of an individual RSP. So what they're doing is they're saying, yeah, we've got a group RSP for your people. We will take the employer contributions, but the actual pricing that they're getting for each individual is much closer to an individual product being two and a quarter, 2.5% in there. So
And as you said, it's big impacts when you're
mhm,
looking at those fees over a long period of time.
yeah.
When we spoke about employees coming in and the longevity of an employee, now ideally we want employees to stay. We want to hire to retire. We want employees to stay for that duration and make their career. But
Hmm.
very often we will pull in talent from somewhere else and they may have had a group RSP or a retirement vehicle set up already. What
Hmm.
does it transfer in? Are they able to transfer money into the existing program? What does that look like?
So it's very, very easy. It's essentially a one-page form. You could also, I believe, with a lot of carriers, you can just call in and they'll help you do it as well. But the money does not go out of market as well. So as soon as it leaves the previous program, it jumps right into the new employer, the whoever your new employer is. It goes right into that program. Yeah, very easy to move money into it. We see also people moving if they have an individual RSP, we see them moving the assets into the group RSP. Again, fees, right? So they're getting those lower fees out of the group program. So we also see that as well. A good advisor, and hopefully I am, will also assist employees with that. Just even having like a group education session about something like transferring your RSPs in, making themselves available to talk to people one-on-one about how to go through the process. But typically it's just a one-page form. What that form does is you would send it to the new employer group carrier, right? So and then they essentially make the request to the previous financial institution. So the individual themselves is not having to go to their financial institution and say, "Hey, I want you to move this money out of your accounts into these new accounts that are not yours." It's the carrier that'll take care of all of that for them. They just have to fill in that form and off you go. And
And
there
if it,
actually are, sorry to interrupt you. There are some carriers that offer the ability to request transfers through either the member site or through their apps as well. So most commonly we see the forms, but there are some there. The carriers are starting to implement that functionality in their digital platforms where you can make those requests online as well.
I was going to say, yeah, the ease of use, I think, is imperative to
Mhm.
employees. This isn't their full-time job. You
Yeah.
know, they want to be able to participate, but participate easily. And
Mhm.
that it leads me into asking about choice for their investments.
Mhm.
Very often, employees will just let it go to the default fund because they find the whole process, even as easy as we try to make it on the apps, they find that process daunting.
Mhm.
Am I really qualified to tell somebody what my choices are? And as perhaps silly as that might sound, it's a reality. That's that person's psychology to
Mhm.
treating on what they feel is their investment. They may have imposter syndrome. Who
Yeah.
knows what you want to call it? What would be your best advice when somebody is choosing going on to the online applications, which are phenomenal these days
Mhm.
compared to what it used to be years ago with the filling out the paper
Proper
and having to go
forms.
back.
Yeah. Yeah.
So what would be your best advice when employees are a bit hesitant about going on and doing that?
So, obviously, first and foremost is feel comfortable that there's a lot of people looking at these investments. It's not just your employer that's decided that they're going to throw this together. You've got the carriers that are doing constant investment evaluation. You've got if you're working with an advisor like myself, we are also looking at it within our organizations. So there's a lot of checks and balances on all of these. Um, there's tools within the online enrollment flow as well that are going to point you to the correct path, essentially. So obviously, it's sort of two ends of the spectrum. There's the person who doesn't know very much about investing, doesn't want to keep checking them, doesn't want to be moving them, this sort of thing. And then on the other side, you've got somebody who knows or thinks they know a lot about investing, and they're going to obviously get some feedback as well. So it's within all of these enrollment flows. It's a very simple 8, 10 questions about what kind of investor you are. For those investors who don't know very much, for those employees or plan members who don't know very much about investing, the rest comfortable that the funds that you will be assigned to will first and foremost they'll be diversified, so it's not just it's not 100% Bitcoin or what have you. There's going to be a very good mix of equity as well as fixed income, which is what you want to see in a portfolio. So obviously the equity, that's stocks, and you want to see, you want to have that equity in there because you want to see that good growth. And then it's hedged a little bit with the fixed income so that if the stock market does take a bad turn, as it has been known to do sometime, you do have some of that money locked away as well. So that's one thing is you're going to, regardless, if you know nothing and you do go to that default fund, first and foremost, you're going to be getting into something that's well diversified. And then second, um, typical default funds are target date funds. So what they are is they are bundles, just like we talked about with the fixed income and the equity, that reflect how long you have until you retire. So somebody who's very young is going to have more equity than fixed income. Someone who's very close to retirement is going to have mostly fixed income and very little equity. So, and that reflects what you want to be doing with your investments, given how long you have until you retire. So that's basically how they work from one end to the other as far as the fixed income and equity. But the other good thing about the target date funds is they're going to change automatically. So you're not having to go back in and say, okay, well, now I've got 20 years till I retire. I have to move to this fund. Or now I've got 15 years. Now I move to this fund. It's going to move you along that glide path, is what we call it, automatically. So if you know nothing, you're going to be put into a really good fund that mixes the equity of mixed fixed income and equity that reflects how long you have until retire, and it's going to change to become more conservative as you approach your expected retirement date.
It brings to mind, why wouldn't an employer put this in place? Because employees want it. You've done surveys at People Corp, you
Mm-hmm.
know the the actionable item there is employees do want access to a group retirement savings program. What fundamentally holds an employer back from implementing?
I think just circle back to what we talked about at the beginning. If the budget's not there, right, that's one thing. But we do obviously encourage them to find room in the budget. So if you think about something like, if you're giving 20% of your workforce a raise every year and nothing to the other ones, right? Think about maybe distributing that around into a group retirement program to obviously build sort of that morale and we're all in this together and looking out for your future. I think there's also particularly within small business owners, there's concerns about minimums. Do we have enough people? Are they going to be putting enough money in for this to be a viable program? Like, are the carriers? A lot of carriers do have minimums. You need a certain number of people. But fortunately now there's enough products and offerings out there that we can essentially build a program for one employee if you want, right? So that's one thing. Just sort of that knowledge gap because there was minimums for so long. A lot of people don't know that those minimums no longer exist. And then the third piece that I would say is their concern about how much time it's going to take. So obviously you've got a little bit of work to do at the beginning to be setting it up, moving employee files, looking at contracts, signing contracts with the carrier, this sort of thing. It takes about 4 to 8 weeks, I'd say, to set one of these programs up. But within that 4 to 8 weeks, you've probably got 2 hours of meetings and 2 hours of actual sort of out of meeting work that the employer has to do. From that point going forward, the administrations of the plan is you need to be consistent on it, but it does not take very long. So administering a system, you've essentially got three things that you need to do: adding new employees, removing terminated employees from the program, and then the third piece is the contribution remittance, which every month you just upload a file and say, this is how much money this person gets, this is how much money this person gets. So once you've got that part, sort of that process down, first time it's going to take you 5 or 10 minutes. It gets down to about 2 minutes after that. So they're not a lot of work, and people thinking that they are is again a knowledge gap that we need to fill on our side. The other thing about these programs too is we refer to them as being very sticky, so they don't move very often. You don't have to have a lot of changes with them. It's not like you're doing renewals every year or this sort of thing. Put the program in place. If it's set up correctly and we've got a good relationship with a carrier, it should run just fine. And every, like we said, 5 or 10 years, we'll take a look at the program and see if there's an opportunity for cheaper pricing. Well, technically, we look at it every year, but it's only going to happen about every 5 or 10 years. So,
Oh,
uh,
yeah, you don't wanna just like moving banks, right? You don't wanna be
yeah,
doing that every year, but you
no,
do
you got to
wanna
have a good
keep your eye
reason.
on it. Yeah,
Yeah, yeah,
for
for sure.
sure. This is always insightful. I really appreciate the way that you speak about group retirement savings
Thank you.
programs. I appreciate the knowledge, but I also appreciate the common sense point of view that you add to it, and I've gotten a lot out of this conversation, and I really appreciate you taking the time.
Not at all, Lori. It's always great to talk to you and the people at Shifts.